Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. I saw a post in a Facebook group asking about what is a K-1. And so today's podcast episode will discuss what is a K-1, who has to file it, and who receives it. I thought it would make sense to go over other tax forms that people receive as a taxpayer as well. If you have a question that you would like addressed on a podcast episode, please email me that question at growyourwealthymindset@gmail.com. Before we talk about K-1s, let's talk about the W-2 form, which I think most people who've had a job are familiar with. A W-2 is a wage and tax statement, and it is sent by an employer to an employee to show the earned income that employer paid the employee during the prior tax year. When you start a new job as a W-2 employee, your employer will have you complete a W-4 form. The employer uses the information on that form to determine how much tax to withhold from your paycheck. As a W-2 employee, your employer will withhold federal, state, and local taxes if applicable from your paycheck. They will also hold your share of FICA taxes, meaning Social Security and Medicare taxes. Your employer will pay Social Security taxes on your behalf as well. You may have additional holdings, including contributions to your employer-sponsored retirement account, healthcare insurance premiums, dental insurance premiums, contributions to flexible healthcare savings accounts, union dues, or other payments and deductions held from your paycheck. If your wages are being garnished, this may also come out of your paycheck before you receive it. The employer must send the employee the W-2 form on or before January 31st each year for the prior tax year. They must also send a copy to the IRS. The W-2 will include all the information regarding wages earned and all the money withheld from these wages. It will also include the employer's identification number or federal EIN, as well as the employer's state ID number. If you work as a contracted individual or independent contractor, then the entity or company or individual that contracts you will likely request you to complete a W-9 form. They will use the information on the W-9 form to issue you a 1099 NEC, which stands for non-employee compensation. Prior to 2020, a 1099-MISC or 1099 miscellaneous would have been issued. They will also send a copy to the IRS and likely whatever state where the income was earned as well. Generally, no taxes will be withheld, nor will any Social Security taxes be paid on your behalf. Like the W-2 form, you should expect to receive any 1099-NEC form by January 31st each year. There are a lot of different 1099 forms that may be issued to you by a variety of sources. 1099 NEC and 1099 miscellaneous are only two of those 1099 forms. You've probably already received at some point in your life a 1099 INT for interest, 1099 DIV for dividends, or a 1099 MISC miscellaneous for other types of earnings. There's also a 1099R, 1099K, 1099C, 1099Q, 1099A, 1099B, 1099CAP, 1099 LTC, 1099 OID. Talk about alphabet soup. Pretty much all 1099s are issued to report some time of payment or compensation, or potentially a loss. A 1099-INT, which stands for interest, reports any interest income above $10, and you likely receive this from any bank that you hold a savings account that pays interest. You may also receive it from a brokerage account. 1099 DIV, which stands for dividend, reports dividend income. 1099 MIC for miscellaneous may be a way to report rent, awards, or even healthcare payments. It's kind of the catch-all. As I previously mentioned, before 2020, the 1099 MISC was used to report non-employee compensation for independent contractors. The 1099-R reports distributions from pensions, annuities, retirement plans, or profit-sharing plans. So this is something that you're more likely to see during your later years when you are in retirement. A 1099-Q reports payment from qualified education programs, including distributions from a 529 plan. So this is something you may receive once you start withdrawing from a 529 plan in order to fund your children's education. The 1099-B is used by brokerages and barter exchanges to report customer gains and losses during the tax year. You may receive a 1099-K if you receive payment from credit card transactions or third-party network transactions above a certain threshold. If you have a short-term rental and you use Airbnb, this may be a form that you receive. A 1099-C is used to report canceled debt, which can be considered taxable income. One example would be if you are involved in a short sale of a property, where the property is sold for less than the mortgage amount on the property. The bank may cancel mortgage debt and then issue a 1099-C, such that you would potentially have to pay income tax on the portion of the debt that was canceled. A 1099-A is for acquisition or abandonment of secure property, and it's used to report the transfer of any foreclosed property. The 1099-CAP form is the changes in corporate control and capital structure form, which is used by corporations to report a substantial change in control or capital structure of the company. Form 1099-CAP is sent to shareholders who receive cash, stock, or other property from an acquisition of control or a significant change in a corporation's capital structure. For a 1099-LTC, the LTC stands for long-term care, and this is a long-term care and accelerated death benefits definition report, which reports long-term care benefits. You may not necessarily owe taxes on the benefits reported by this form. The 1099-OID is the original issue discount form, and it's issued if a taxpayer receives taxable income due to the reduction in the price of a bond or other debt instrument from its face value at the time it was issued, and is taxable as interest over the life of the obligation. This could apply to holding a bond, note, certificate, or any other form of indebtedness that has a term of over 1 year. I'm probably missing a few types of 1099s, but I think this gives you a good idea of what 1099s are used for. If you somehow had compensation, which is taxable, the IRS has a form to make sure that that compensation is reported so they can collect your taxes. And that's really where a lot of 1099s come from, just specific instances of where there might be some way you have to pay taxes from some compensation or transfer of assets. Along those lines, the K-1 serves a similar purpose in that it's another IRS tax form to report compensation. Like a W-2 or 1099 NEC, you may be issued a K-1 depending on your work situation. You may also be issued a K-1 depending on your investments. A K-1, or its full name Schedule K-1, is an IRS tax form that is issued by partnerships, S-corps, and estates or trusts. A K-1 is issued annually to partners, shareholders, and beneficiaries, and holds information necessary to accurately file tax returns. K-1s contain financial information like income and earnings, losses, deductions, and credits. There are 3 types of K-1 forms, which are used by the different types of entities. The partnership K-1 form is filed by partnerships, along with the partnership tax return form 1065. Each partner will receive the K-1 form to calculate their personal income tax returns. The S-corp K-1 form is filed by S-corps, along with its annual tax form, the 1120-S. Each shareholder of an S-corp will receive a K-1 form. The third type of K-1 form is for estates and trusts. It gets filed along with the estate or trust tax form 1041. The estate or trust will issue a K-1 form to beneficiaries who have received income from the estate or trust. The individual taxpayer doesn't file a K-1 form. The entity that issued the K-1 form will file it along with the entity's tax return. As an individual taxpayer, you will need the information contained on the K-1 form to fill out your personal tax return. In this way, it's similar to W-2 and 1099 forms. If you are in a partnership, you will, or at least you should be, issued a K-1. This includes investing in a partnership as a limited partner, like investing in an individual syndication, as well as investing in real estate funds. K-1s may also be issued by some exchange-traded funds, generally those that invest heavily in commodities. If you are a partner or shareholder in a medical practice that is an S-corp, then you'll also be issued a K-1. The K-1 will state each partner's holding within the partnership or S-corp and show their share of the returns based on how much ownership they have in the partnership or S-corp. Due to the complexity of calculating each partner's share, K-1s are notorious for being sent out late. Technically, it's required to receive them by March 15th, but in reality, I've received K-1s as late as September. It's important to keep track of which K-1s you expect to receive, since you won't be able to complete your personal taxes until you receive all your K-1s, and this may not happen until after the April 15th tax filing deadline. There was one year where I forgot about a K-1 that hadn't come quite yet, and I filed my taxes too early and ended up having to file and pay for a revised tax form to include that K-1. Even if you don't get all your K-1s by April 15th and you file for an extension, your taxes are still due by April 15th, even though, of course, you don't know how much you actually owe. If you underpay, you'll end up paying interest and possibly a penalty on the amount unpaid. The interest rate last year was 8%, so it's kind of hefty. It's also possible that a K-1 can trigger the alternative minimum tax. If you've already filed your taxes, great. But if you haven't filed them yet, make sure you're collecting all your tax forms so that you have everything ready when you start working on filing your taxes or when you meet with your accountant in order to have them go over your taxes. If you have straightforward taxes, receiving W-2s, and maybe a limited number of 1099s, then maybe you are able to do your own taxes. However, once your taxes get more complicated with multiple K-1s and or significant 1099 NEC income, it's time to consider not only getting a CPA to help you file your taxes, but one that could help you also with tax planning. Remember, if you talk to your accountant only after December 31st, they can only file based on the actions you took during the tax year. By having a tax preparer that you can meet with throughout the year, you can make adjustments and try to do things to minimize your taxes. And this is what I mean by tax planning. Our US tax system can definitely be confusing. And there's been a lot of talk about how to simplify our tax system. However, I'm not going to hold my breath that we have a simple tax system anytime in the near future. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you have any question about personal finances, investing, or money, feel free to email them to me at growyourwealthymindset@gmail.com. Have a great week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.